First of all, and most importantly, this is global. At a point in time when I described gold as comprising 0.5% of Americans' holdings, it comprised 1% or twice as much of foreign holdings. What's happened since is that mostly foreign currencies have declined relative to the dollar. So the gold price has gone up in dollar terms, and the dollar has gone up in rupiah and renminbi and yen and euro terms. So the gold has revalued in the foreigners' accounts, and they already had a higher percentage, a higher market share in gold than we did. And this chart demonstrates it. Gold continues to be substantially underowned. What's interesting about this chart is where you would call reversion to mean. If you look at 1980, when gold was in favor, gold had an 8% market share. What I'm interested in is even if gold didn't come close to capturing its former market share, if there was a reversion to the 40-year mean, my suspicion is that gold demand would be substantially higher than it is today, too. Note something else. The market share of central banks' holdings of gold had fallen substantially. So there's competition for gold in the market now. To the extent that the retail buyer, the private buyer, comes into the gold market, there is still substantial central bank buying. So there's two classifications of buyer now. All of that's bullish. Investor behavior, however, which is sort of what that chart is about, isn't as important to me because in the near term it's shaped by narrative. Then investor motivation. Investor motivation, I think, will be shaped by the deterioration of purchasing power in fiat currency denominated instruments. I think that's really important. In other words, the narrative will follow the incentive.
According to Rick Rule, gold's recent surge wasn't driven by Americans fearing dollar decline. It was forced buying by foreign central banks. He warns the real retail buyer still isn't in the market. Mining stocks are massively undervalued at current gold prices, and the biggest move is still ahead.
Our crew are excited by what's happening in gold, and they believe in gold. But you live in Florida. It's like if you went to a rural Pentecostal church in Florida and asked the choir if they believe in God. You're going to get an affirmative response. But most people aren't in the gold trade yet, which tells me that gold has further to go. Now, it may be that the adherents, it may be that choir's out of breath, and there's no move in the gold price for 2026. But the whole set of circumstances that propelled gold is very much intact. So the trade is very much intact. What's important to note is the second part of your question, I think, for those of us who care about the trade, which is to say that if the gold price doesn't go up from here, or the silver price doesn't go up from here for a year, there's still room to run the stocks, because Wall Street's calculation and Bay Street's calculation on the value of these companies is predicated on $3,500 gold and $45 silver. Now, if your earnings estimates are based on $3,500 and you're selling the gold for $5,000, it's kind of hard not to get a surprise. And if you redo your net present value calculations or future cash flows at $5,000, up from 33, 34, 35, you're going to have some positive surprises. Same thing in the silver market. When I look at the Bay Street earnings forecasts and the Wall Street earnings forecasts, they're using $45 silver. If you revalue these things at today's silver price, you get a much higher number. So I suspect, particularly with regards to the senior silver producers, that if I see a sideways movement in silver for 12 months, I see stocks that have 50% to run on a valuation basis alone. The good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices. I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because silver occupied a speculative position in my portfolio. Gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. You'll recall, Dunnigan, in our earlier interviews, when I described silver as a coiled spring, that when the hate dissipated, it would be easy for the price to double. Well, it didn't double. It went up fivefold, sixfold. When that happened, the reason that I owned my silver went away. I owned it as a speculation. And I had to decide, was it still the best speculation in my portfolio relative to the amount of capital I had tied up, or was there something better to do with it? And I decided for half the money that was in my silver portfolio that I'd rather buy the silver stocks. Because if silver didn't go up anymore, by definition, I couldn't make any money. If silver did go up, the silver stocks would go up too. But if silver just went sideways, the silver stocks would go up by 50%. That seemed like a better speculation to me. For me, it's all about arithmetic. Ironically, if the price of silver fell, while the price of the silver stocks would fall, the values wouldn't need to fall very much because the net present value assumptions were made at a $45 silver price. So if the price of silver fell from 80 to 50, that's still above the consensus silver price that people have used to calculate those net present values. So it seemed to me like I had a better speculation in the silver stocks than the silver. Now, for me, gold is a very different circumstance. I save in gold. So 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold. Because I wanted to take some of my speculative gains all the way off the table and get them out of harm's way. And as you know, Dunnigan, since the year 2000, I've maintained liquidity in US dollars, but I've saved in gold. I regard them personally for myself as very different assets or asset classes. The slow realization that people have that their savings and salaries are not keeping pace with the deterioration of the US dollar and that they need to change their savings matrix to protect their capital. I laugh. It's tragic for most people, but that's going to have dramatic impact. You know, when I say, and I need to be better about how I communicate this. When I say in the abstract that I believe the purchasing power of the US dollar declines by 75%, people nod sagely and then, go on about their day. What I need to say is that a pensioner who is living today on $4,000 a month will require $16,000 a month to maintain the same standard of living 10 years from now. And where will that extra $12,000 come from? When people personalize it like that, when people understand that if they're getting paid 4% on their savings, in a currency where the purchasing power is declining by 4% a year, what's happening is they're losing half their savings rather than making 4%. People need to personalize this. Whether or not they buy gold is of less interest to me, frankly, than whether they understand that they are responsible for their future and their children's future. Their community isn't, their government isn't. What Congress did is they announced to the world that their reelection was more important than the sanctity of the US dollar. And that time, the world had 5 years preparation, and gold went on a real romp. Gold went from $100 at the end of 1975 to $850 by the end of 1981. It was a hell of a romp. I think past is probably prologue. I think over time, the portfolio managers get ambushed by reality, much as they did in 1972 and 1973. And then I think you're going to see a fairly dramatic response. Well, I believe, just because I read the analyst reports, that the analyst reports, both in terms of their earnings forecasts and the net present value calculations, are predicated on sharply lower precious metals prices. If the precious metals prices trade sideways for a year, it would suggest that valuations can move higher. The consensus metals prices on Wall Street and Bay Street around gold seem to cluster in the $3,200 to $3,500 an ounce range. Now, it seems to me if you make the stuff if you sell the stuff for $5,000 and your earnings forecast is based on $3,500, that arithmetically you're pretty likely to surprise folks, and the surprise is likely to be good. Similarly, if you're doing a net asset value calculation of future cash flows and discounting it back at Wall Street's prevailing 5% discount rate, and you're using a $3,500 denominator, which is to say a $3,500 gold price in a $5,000 world, that you are understating the value of that company fairly substantially. What people are really concerned about is the maintenance of their purchasing power. It makes sense in a sovereign debt crisis that people didn't want to own foreign bonds. But you'll note that in sovereign debt crises, U.S. Treasuries did very well. What changes now is that U.S. Treasuries, I think long-term U.S. Treasuries, I think their future performance was defined by Franz Pick, when he described them as certificates of guaranteed confiscation. If you buy a 30-year bond yielding 5.2, and your purchasing power is declining by 8 to 10% compounded, when the market begins to realize that there's a negative real interest rate, the capital value of the bond declines at the same time that the purchasing power of the yield and the stored principal declines. And that changes that graph really substantially. Really substantially. Imagine for a second that rather than being a gold dealer and a podcast host, that you were running the University of Florida endowment, and you were responsible for investing the endowment of the University of Florida for the benefit of the institution and hopefully its students 30 years from now. Don't say quit. Don't say I quit. Imagine that you inherited a portfolio that was 65% long bonds because they were riskless. And imagine that you suddenly woke up at 2:00 in the morning and said, wait a minute. In 30 years, the purchasing power represented by the principal in that bond has declined by 80%. Dunnigan now has to do something. And I think that's the realization that people are coming to. Their fondness for long-dated treasuries is a relic of the period 1982 to 2022, where the U.S. dollar was strong, where real and nominal interest rates were falling. And in 2022, and you saw that on that chart, the world changed. Listen, the Gatta guys are good friends of mine. I enjoy them. I enjoy the fact that they enjoy debate, often with me. I don't believe that markets have been artificially suppressed in the long term. Markets are manipulated all the time. Markets as big as the Treasury market are manipulated. Traders manipulate markets. That's what they do. This spoofing that you've seen will never quit, ever. But the idea that there was a 40-year-long conspiracy to depress the price of gold while the U.S. dollar was strong flies in the face of arithmetic. It's convenient for people who made the wrong bet psychologically, but it's silly. Gatta has been reduced in importance in terms of the public debate around the gold bugs because the gold price has gone up. You don't need to blame anybody. I mean, the gold price as recently as the year 2000 was at $256 an ounce. Now it's at $5,000. Some suppression.